Your cart reaches checkout at exactly $100 before sales tax. The scanner beeps. You tap your card. And for 1 second, the whole 100 looks like revenue for the supermarket, but almost none of it stays there. In a model based on Kroger's fiscal 2024 accounts, $77.30 is already assigned to merchandise costs. Then come employees, utilities, rent, equipment, financing, and taxes. After all of that, about $1.81 remains as net income. That is the first surprise. The second is that this still does not tell us who grew, processed, packed, transported, or imported the food. For that, we need a different map. One receipt, 2 accounting lenses, add them together, and you count the same dollar twice. So let's follow your 100 correctly. First through the supermarket, then through the food system behind it. Start with the retailer's income statement. Kroger reported more than $147 billion of sales in fiscal 2024. Scale that enormous company down to your $100 checkout, and the first block to leave is $77.30 of merchandise costs. The name sounds like a simple supplier invoice. It is not. Kroger says this line includes the products themselves, discounts and allowances, advertising, inbound freight, warehousing, transportation, and food production. In other words, part of the supply chain is already folded inside the retailer's first expense line. Subtract it, and $22.70 remains. That is gross margin. It is the space between sales and the broad cost of getting merchandise ready to sell. It is not a bag of profit sitting in the manager's office. The store is still open. The lights are still on. Thousands of items are still cold, priced, stocked, guarded, scanned, and replaced. Gross margin is what must pay for that operating machine. The next block is $17.29 of operating, general, and administrative expense. This is where many of the people and systems live: wages, healthcare and retirement benefits, utilities, credit card fees, corporate support, and some delivery costs for digital orders leaving retail stores. Then remove 60 cents for rent. Remove $2.21 for depreciation and amortization. That is the accounting cost of using stores, refrigeration, shelving, scanners, warehouses, software, and other long-lived assets over time. Financing and other net expenses take roughly 34 cents in this illustration. Income tax takes about 45 cents. What survives is $1.81. Kroger is not every supermarket. Its company-wide numbers include fuel, pharmacy, digital operations, manufacturing, and other businesses. But the thin ending is not unique. Albertsons reported a fiscal 2024 gross margin of 27.7%, yet net income was only about 1.2% of sales. An industry survey from FMI put food retailer profit margins at 1.6% in 2023. Different companies, different mixes, same basic pressure. A supermarket can ring up mountains of revenue while keeping only a small ridge at the end. Now we have to avoid the most tempting mistake in this story. Do not take the $77.30 of merchandise costs and label it the manufacturer. And definitely do not label it the farmer. That line already contains freight, warehouses, advertising, transportation, and production work performed inside the retailer's system. It is an expense category from one company's accounts, not a census of everyone upstream. To open the supply chain, we switch to the United States Department of Agriculture's food dollar. The USDA builds national economic accounts for food purchased at home. It can divide a representative dollar by farm versus post-farm value, by industry group, or by labor, property income, taxes, and imported inputs. These are averages across an entire year. They do not describe every tomato, every store, or every neighborhood. And USDA explicitly warns that industry value added is not the same as company profit. This second lens answers a new question: who contributes value before the food reaches your cart? There is one more boundary to fix before we split the basket. The USDA's farm and marketing shares apply to domestically produced food, but a real supermarket also sells finished food imported from other countries. In the 2024 Food at Home account, total spending was just over $1 trillion. About 84.9% was domestic production. About 15.1% was directly imported finished food. So our reconstructed 100 starts with $15.09 assigned to those finished imports. The remaining $84.91 is the domestic food system. Inside that domestic portion, farms received a gross share of 18.5 cents per dollar. Post-farm marketing accounted for 81.5 cents. Apply those rates to the full basket, and the clean three-part picture is this. $15.71 is the gross return linked to farm establishments. $69.20 is post-farm marketing value, and $15.09 is directly imported finished food. Exactly $100. But gross return to farms still does not mean farmer profit. Farms buy seed, feed, fertilizer, equipment, fuel, insurance, transportation, and many other inputs. The farm share reaches the farm gate before those bills are paid. Now open the $69 post-farm middle. On the full basket scale, food processing contributes about $23.50 of value. Food wholesale contributes $9.73. Transportation and storage contributes $5.34. Food retail contributes $24.59 of value. That last number is not the supermarket's profit. Value added means sales minus purchased inputs at that stage. It must still support retail labor, buildings, equipment, taxes, and capital. Remember the first map. The final net income can be less than $2. The rest of the upstream diagram includes agriculture, energy, finance and insurance, legal and accounting work, advertising, and a small food services component. Across the domestic food-at-home chain, salary and benefits account for 47.2 cents per dollar. The people stocking your local aisle are only one part of that labor. Workers also operate plants, warehouses, trucks, farms, offices, and distribution centers. You may notice there is no separate packaging percentage in the current USDA bill. The model uses 13 industry groups, and packaging is embedded inside the businesses that make and use it. We can see the box. We cannot honestly invent a standalone number for it. Product mix changes everything. In 2024, the farm share for fresh eggs was 69.1 cents per domestic dollar. Beef was 52.2. Fresh milk was 50.8. Fresh fruit was 39.6. Now move toward products with more transformation. Snack foods carried a farm share of 9.7 cents. Bakery products were 4.8. Soft drinks and bottled water were just 1.3 cents per domestic dollar. That does not prove a bottle of soda is unfairly priced. It tells you that the farm commodity is a small part of the finished economic product. A loaf of bread is not wheat with a barcode. It is milling, formulation, baking, quality control, packaging, distribution, shelf life, merchandising, and the risk that yesterday's loaf will not sell tomorrow. A branded snack also pays for a repeatable flavor, a factory, a printed package, nationwide distribution, advertising, retailer placement, and enough inventory to appear whenever you want it. Fresh food can send a larger share toward the farm because less industrial transformation sits between harvest and sale, but it can demand refrigeration, careful handling, rapid transport, and aggressive spoilage control. The raw ingredient is only one layer. Convenience is manufactured too. Private label changes who controls some of those layers. Kroger said its Our Brand's products generated more than $32 billion of sales in fiscal 2024. It also owned 33 food production plants that supplied about 31% of our brand's units sold in its supermarkets. That means the retailer is not always just the final shelf. It can design the product, choose suppliers, control specifications, manufacture some units, negotiate packaging, set placement, and sell under its own name. A national brand performs or purchases many of those functions outside the retailer, then negotiates for access to the shelf and the customer. This can give a retailer more control over cost, differentiation, and the path through the chain. It does not create a universal private label profit percentage. Milk, cereal, frozen meals, and paper towels have different economics. Promotions and customer loyalty change them again. The important point is structural. A supermarket can move the walls between retailer, processor, and brand. The receipt stays $100, but the organization collecting each layer of value can change. Now look again at the $1.81 left in the retailer illustration. If one additional dollar of cost hits that $100 sale and the store cannot offset it, more than half of the illustrated profit disappears. That is why small operating changes matter so much. A refrigeration failure does not merely raise the power bill. It can destroy inventory. A forecasting error can leave a shelf empty when demand arrives or full when a product expires. Theft, damage, scanning errors, spoilage, and markdowns all become shrink. Kroger said lower shrink helped its gross margin in 2024. It did not publish a clean company-wide shrink rate in that release, so we will not invent one. The mechanism is enough. Loss hits a business whose final margin is already narrow. Labor can break the model too. The store needs enough people to receive, stock, clean, prepare, pick, and scan products. Too few, and availability and service fail. Too many for the sales volume, and payroll consumes the margin. Rent is due when traffic is weak. Interest is due when prices are under pressure. Refrigerators run overnight when the store is empty. The supermarket survives through throughput. A lot of inventory must move accurately and repeatedly through a system with little room for error. Return to the checkout. The retailer map says your 100 becomes $77.30 of broad merchandise costs, then operating expenses, buildings, financing, and taxes, leaving about $1.81 of net income in the Kroger-based illustration. The supply chain map says the same 100 supports directly imported finished food, gross farm receipts, processing, transportation, storage, wholesale, retail, energy, finance, professional services, advertising, and labor across the system. Those maps are both useful. They are not additive. Your exact cart will be different. A basket of eggs, beef, and fresh milk sends a different share toward farms than a basket of soda, bakery products, and snacks. A private label basket rearranges control again. Geography, promotions, taxes, waste, and timing change the result. But the mental model holds. You are not paying only for edible material. You are paying for transformation, coordination, selection, refrigeration, forecasting, financing, local access, and the option to choose dinner at the last minute. The receipt shows $100 leaving your account. The supermarket does not keep it. It conducts it.